Hello, everyone. All right, good to see you. And I first off, I have to share with all of you something that I'm very proud of. Check that out. It's in the news. It must be right. It's right there. It's right there. And who confirmed that? Abraham Lincoln confirmed that. Yes. All right. Hello, everyone. Okay, so here we go. I'm going to close this shade. I'm back in my office. I'm not in my studio where everything is perfect. Everything's absolutely perfect. Okay. Once again, we're back with Arbor. And, a couple of the names that they mention are names that I know personally, which I always hate to see that. Hello, Raymond. It really bothers me when I see that, but I gotta, tell you about it because there's this particular article that I'm going to be quoting from really goes in deep and peels back the onion a little bit on the rescue funds or the debt funds. These are very tricky cases, and when you just do the math just doesn't make sense. It doesn't math, as the kids are now saying, which I really like. All right, here we go. So the Arbor is foreclosing on more properties. The name of the property is Park North Apartments in Houston. This was let me just clarify that this is actually done by a let me see. Just want to make sure. Yeah, Park North. So this is actually done by one of these syndicators. Went to I believe he's tied in with a couple of hotel teachers, not hotel, but mobile. What am I saying? Multifamily home trainers, weekend boot camp guys. Two guys who I happen to like. They're really good guys. They were on my podcast years ago. I shared the stage with one of them, and I just really, really thought he was a great guy. But this is one of their proteges, one of their students who obviously bit off more than he could chew, and the numbers just are tanking. And I'm going to give you, in this conversation, I'm going to give you actual numbers. And so if you're just watching this, or you're not, or you're driving or something, I'm going to explain to you the numbers. I'm going to make it very, very clear so that you can see exactly how this all ties together. So the property is Park North Apartments in Houston. Now, this one is a non-collateral leveraged offering, CLO. I got those letters wrong again. CLO. It's not a CLO. It's a non-CLO foreclosure. What that means is that Viceroy, the entity that I'm reading from that wrote this report, had to deduce this information from public documents, from court cases, and not that it was ever reported to the governmental powers that be, like a Fannie or a Freddie or a CMBS loan would be. When you pull down the information from like a CoStar report, a lot of that comes directly from a CMBS report, which means that it's very accurate information. This one did not come from any centralized source, but it came from court documents. It is tied to Inman Equities. Inman Equities is the syndicator. He's the weekend guru protege. So check that out. So Arbor has kicked the can of delinquent loans at their own expense, and Arbor has extended mezzanine financing to delinquent customers. And wait until you see what that really means from the numbers. And I love, oh my gosh, Viceroy. They are Viceroy Research Group, viceroyresearch.org. Man, they are bordering on defamation and libel in these documents. The things that they say, they better have the receipts. I'm sure they do, but some of the stuff they say is crazy. Like, for instance, they said, listen to this, the way they wrote this. Viceroy believes Arbor has modified North Park's loan internally at their own expense, meaning they wrote it down and they took the hit. Arbor did. We also believe fresh equity from the borrower, which has been grifted from syndicate investors, has been utilized to meet Arbor's interest expenses going forward. So in other words, they had a cash call, or they had one of these debt funds that they are promoting and had to turn around and give it to Arbor to shore up their own asset. But I can't believe they use the term grifter. Boy, that's crossing the line. And also, oh, and I love this term. You're going to love this one. This is right, another Viceroy bordering on defamation. Accordingly, we believe that this loan has been recapitalized by Arbor at its own expense per historical precedent. You can read more about it, about their recapitalization. Oh, wow. But talking about this particular property, they've been sued by their third-party property manager twice in the last 2 years for non-payment. Ooh, I'll tell you, being a property manager and controlling the capital, you get paid first. Whenever I had a slow month, my property manager always got paid. That's why I teach my students to set up their own property management company, so they always get paid. And in this particular case, by the sounds of it, the third-party property manager let the syndicator manage the money. Okay. Let me see the Arbors. Okay, now let me give you some numbers, and here we go. This was a big deal. This was a $56.27 million debt on a $53.9 million appraisal. Okay. Here's where we get 2006 all over again. Here's where we get all of those crazy valuations that the banks were lending. And those appraisers some of them got in big trouble. It's happening again. And I'm going to tell you right now, and this is actually, you can read about this. Okay. So Magnify. Oh, hello, Magnify. Okay. So, something? Oh, here it is. I have the answer for you. And it's called Star Personnel, Inc. Star Personnel, Inc. 1R. Let me see if I can give you any more information. The case was filed in 2023, December 2023. I'm trying to figure out where they did it. Yeah, you know what? What you might want to do is, if you look this up on their docket, you can go to viceroyresearch.org and pull down this report. The name of the report is Arbor, the Foreclosure of Park North. And dig through that. You can see exactly who Star Personnel, and there's actually a hyperlink for Star Personnel. You can find out who the people are if you're so inclined, Darren. Okay. Arbor's 50. Okay, so there's the valuation issue. The property appears to have been bought for approximately $70 million in 2022 with a $23 million equity by Inman Equities. This effectively means that every one of these investors has lost their entire investment. They bought it for 70. It's now valued at about 53. Everybody just lost their money. And if they're bringing in rescue capital is always going to go above those people. So if they think they're going to hang on to save it, good luck to them. Inman Equities, the GP, has opened a debt fund. Oh, how convenient. And when you go to read these debt funds, what they talk about is like exactly the same stuff they talked about on the initial investment, how great it was and how everybody's going to make so much money. And now they're talking about that on the debt fund, that they're going to go back in to save the property that the initial investors just lost everything with. Oh, and wait until you see. There's some talk about investigations for those types of investments. Inman Equities has opened a debt fund, which it claims it will be used to fund multifamily debt projects in Chattanooga, Tennessee. This one's in Houston, but they have properties in Chattanooga, Tennessee. It ridiculously, and I'm using, this is a quote, it ridiculously claims to be able to return a 10% annual dividend paid monthly. This is completely unrealistic when you sit there and you do the math. The 10% debt fund, and this is from an advertising from Inman Equities. The 10% debt fund income out opportunity is making a loan to a qualified borrower, that's them, for the acquisition of 3 multifamily assets totaling 56 units located around the Chattanooga MSA. The acquisition opportunity offers attractive upside to the borrower by purchasing at below replacement costs and by implementing thoughtful renovations that will serve to position the assets to better compete with other like-kind multifamily properties in the market. So in other words, they're buying their own properties at a huge discount. So the initial investors, they're out. Debt fund people, you're now in. Viceroy believes this debt fund will inevitably be used to salvage Arbor debt from existing equity projects such as Park North. In other words, we're raising the money for Chattanooga, but we might be using it down in Houston. And that is speculation on Viceroy's part. They're basing it upon what other syndicators have done in the past. That's crossing a line. They shouldn't be speculating. They should be sticking to what they know. The Chattanooga property was previously sold at just $7.5 million in 2018, or $63,000 per unit. This is less than the proposed greater than 10% rate that the debt Inman intends to burden the property with. So in other words, they're going to greater than 10%. They're going to burden the property so that they can pay their investors 10%. The property is probably going to pay 13% for the loan. And when you add all those things together, they're already overpaying for the loan. It doesn't make any sense. This property can't support it. The property cannot support it. All right. Now, here's another great line from Viceroy. Syndicators are compensated, and this is such a true statement. You've heard me scream this from the rafters. That's why on our hotel deal, we're not doing a syndication. We're not doing an acquisition fee for this very reason. And here's what Viceroy says. Syndicators are compensated on assets under management and amounts of debt they can raise. There is little incentive to find a priced deal. Wow. A little incentive to find a good investment. You want to know why? Because these syndicators, if they're not putting in any of their own money, if they've got nothing at risk, no skin in the game, they're a broker. They're not an investor. That's why in our deal, every one of the GPs, every one of the leads has put their own money in the deal, or they've signed to the dotted line. And what I mean by that is they are guaranteeing the loan. So Inman's case study for the Canyon Park closed offering claims this is Inman, the Inman Equities. This is another deal that they closed. This is something that they're now claiming on the internet, on their websites. And so that's what Viceroy is talking about here. They claim that it generates 22% internal rate of return, IRR, per year. Trustee filings. You start talking about trustees, you're not having a good day. Trustee filings show the loan was modified from distress in June of 2023. Its debt coverage ratio in June of 2023 was 0.74, meaning it will be required to borrow more or capital call investors just to keep it afloat. They go on to say, we reiterate that Arbor has already established a precedent on a recapitalizing loan at its own expense and has extended mezzanine financing to delinquent customers. Arbor has fixed the interest of Elevate's. Okay, now this is where it's starting cutting close to home. Elevate, that's Georgia Brew's program company, and I like George, but I think he's overextended. He's probably having a bad night's sleep a lot of times, and my heart breaks for him because I've been there. Arbor has fixed the interest of Elevate's $32 million floating rate, the Selena debt, at 6%. Okay, so what that means is that George was able to successfully negotiate with Arbor to set his interest at 6% and not to go up any higher. This represents a discount on Arbor's part of over 300 basis points. That's 3 points, 3% interest that Arbor typically expects, because of the contracts that they signed, typically expects that should be their money. But they just gave it to George. Bravo to you, George. But Arbor's got to come for it somewhere. Elevate created a new commercial real estate debt investment vehicle to provide fresh capital to the Selena in the form of a rescue loan carrying interest of let me put it to you this way. Before I tell you what the interest rate was, I should have maxed out on my credit cards and invested in this rescue fund, and I would have made the VIG 18%. This rescue loan has a second ranking lien on the Selena. Okay. So in other words, Arbor is saying, yeah, we'll let you do the debt fund. We'll allow you to put debt on these loans as long as we get the money. The rescue loan is presumably intended to meet Arbor's interest expense on the 6% loan going forward. So in other words, they're creating a debt fund capital to put on a property that is in financial distress so that they can pay the interest on that initial loan that the property can't afford to begin with. So where's the 18% coming from? That doesn't make any sense whatsoever. The Selena has $42 million of debt against an independent valuation of $40 million, which implies a current cap rate of 1.3%. In other words, they've just valued this property at 1.39%. Think about what has to happen on this property for anybody to make any money on this deal. All right. So we go into some of these things. The occupancy rate in December of 2023 was 74.8%. It wasn't even at a level that anybody could get a new loan on the property. And the loan to value based upon Viceroy's calculations is actually 148%, because they're coming up with a valuation far lower than what the loans are. So that LTV is 148%. So the loan is 48% over the value of the property. 100%. And the thing is, to get for Viceroy to calculate out that number, they had to make some assumptions. Let me just tell you what the assumptions were. You can see that even the assumptions are too rosy, which means that the numbers are BS. 100% occupancy rate, fixed operating expenses. the net operating income will have to approach a 200% increase in order for these numbers to work out. And then they'll have to wait until a cap rate of 5.5%, representing best in class assets in this particular sector. So it is not going to work. Even with these imaginary numbers, Arbor still will not break even on its $32 million loan when the Selena inevitably collapses. And they're out there promoting more money, and they're offering 18%. That's crazy. That is absolutely crazy. 18% on a rescue loan. And all of the money's going right to pay the interest on the 6% that they couldn't pay to begin with. That doesn't help me. Help me understand. How is that possible? How is that in any way possible? Viceroy says, we further believe syndicators listen to this one. Syndicators refinancing their own existing failed investments, that they are abhorrent, evil grifters who are swindling the average Joe and throwing good money after bad. You know, I'll tell you guys, I've been in that situation. I never raised money. Like, we did cash calls, and eventually our investors said, we're done, give the property back. And I'll tell you something, that was the right decision. Instead of fighting to keep this this burning ship afloat, let it go back to the bank. You'll be just throwing good money after bad. Why? Because you're out there looking like some great multifamily guru. You don't want to appear on the Real Deal. You don't want to show up on Viceroy. Guys, at some point, the banks, I mean, you look at some of those big investment companies, when they make a mistake, they take the loss and move on. And sometimes that's the right thing to do. So keep that in mind. If any of you are in this situation, or you're getting the cash calls from your investors, you know what? It happens. If you don't lose money in real estate, you're not a real estate investor. I've lost millions. I've made millions. But, you know, that's what, like, one guy told me one time. He said, Charlie, all real estate makes money. Oh, really? He goes, you just have to own it when it does. And I thought, oh, you know what? That kind of hurts, because I owned a nice property and I didn't make a dime on it, and the next guy made millions. All right. Now, final part of this discussion has to do with what's going on at the banks, especially Arbor and their minions. This has to do with the appraiser and one of the brokers for Arbor. And actually, I had a little dealings with this broker, and the guy I was dealing with was a good guy, but the other guy that I was dealing with jumped ship. He got out of there. All right, in June, this is from June 6th. This is just recently. Viceroy's unanswered inquiries to Arbor and the sell side about its commercial ties to BBG and Meridian. Okay, so BBG is an appraiser that Arbor used to appraise these assets, and Meridian have been answered thanks to vetted whistleblowers and confirmed by multiple industry sources. Our sources similarly confirm that Fannie Mae is running a parallel investigation into BBG appraised loans, also implicating the managing director, John DiPietra, substantially all of which were originated and or underwritten by Arbor. Okay. Now they're starting to go after the vendors that Arbor used, the third-party reports that everybody pays for. Now stuff's starting to get real. We understand that combined value of Arbor's loans, potentially subject to Fannie Mae repurchase demands. Okay, That a repurchase demand for a dust lender like this is the equivalent of a cash call or even a foreclosure. That's the equivalency for these type of people, and or make whole payments or other loss sharing arrangements. The combined value of that for Arbor is approximately $1.8 billion. So in other words, that's why Viceroy continues to say, we reiterate our belief that Arbor is a donut, $0. So now let's talk about BBG a little bit more. On May 24th, the Promote, which is a industry rag, reported that Freddie Mac will no longer accept new loans involving appraisal firm BBG, Kiss O Death, as it conducts an internal investigation into mortgage fraud, particularly implicating New York Managing Director John DiPietro. So BBG must be a big organization, and they had this one office up in New York that was playing a little fast and loose with the calculator. We note that defrauding either Freddie or Fannie have severe consequences for the originators, underwriters, and our appraisers. However, the loss sharing contingency form with Fannie is much more severe. Arbor falls within that latter category. And then also they talk about Meridian Capital as an originator of the loans, which are also being inspected by Fannie Mae. Oh, and I felt bad for, I had this little story about, what's his name? Ben Inman of Inman Equities. He's the one getting his property foreclosed. It defaulted on a $56 million loan and has just recently had a taxable value of $54 million. And it was acquired in 2022, which means it was recently acquired. Could even be less than 2 years. And the valuations tanked, absolutely tanked. So that's all I got to say. It's always sad to hear those stories. It really is. I don't want to see anybody get hurt. Mr. Inman, Ben Inman, the guy just wanted to make it in the multifamily business, and he got excited and was able to raise all that money and buy these properties. And hey, you own multifamily, you're always going to make money. No, that's not it. Not it at all. It's very important that any of you looking to acquire right now, you sit back and you realize that there's a lot of distress going on, and we need to take advantage of it as investors. We've been talking about keeping our powder dry and sitting on the sidelines. Well, get off the sidelines, because now's the time. You're seeing it at all different levels of the business. I had a client of mine call me today, and that a guy owns an office building, and his company's in trouble, and he needs cash fast. So he's looking to make a quick deal, and it could be a huge savings on my client. He's going to make millions on this deal, and that's the cool part about this business. Just be patient, but always be out there looking. If you're not letting people know that you're out there looking, no one's going to call you up when a great deal happens. So always make sure that you're out there knocking on doors, letting people know you exist. Otherwise, it's just you sitting in your mother's garage trying to start a new business. You got to get out, push yourself out. All right, that is it. Let me see. That is it. I appreciate everybody joining me. That was fun. I got to jump on my 4:00 call for my hotel cohort program. We're days away from closing on the Louisville deal. And I'll keep you all informed of that. I'm sure I'll have my partner David on, and we can talk more about that when it happens. Otherwise, thank you very much, Darren and Kristen. I appreciate it. And we'll talk to you all soon. Bye, everybody.